What is happening with GameStop stock prices? Well, will it hold?
Wallstreetbets, which is really driving this, what they've done, that's a site on Reddit, what they've done is target large short positions.
We have been given the scientific knowledge, the technical ability, and the materials to pursue the exploration of the universe.
GameStop was 148% short.
3, 2, 1, 0. All engine running.
I actually think they're smarter than you. They're after the ones that are too short now and say, I think GameStop is going to 250. We like the stock. We like the stock. We like the stock. Ronnie Cohen's in. He won 15% at $8. He's on the board. We like the stock. We like the stock. We like the stock.
Welcome to the Money Growth Academy. My name is Dee, and it has been an interesting development, to say the least, of what's happening with GameStop. But before we get into this, take a second, pound that like button, and hit that subscribe to ensure you stay up to date with us on any market changes. Yesterday, GameStop wasn't prevalent in many of the mainstream financial media coverage, but in the Reddit pages, it went crazy. There has been a literal melt. Well, I call it really a melt up of GameStop stock price in the last week. What I mean is there seems to be an all-out online Wall Street protest against Wall Street short selling, and GameStop just happened to be the benefactor. That protest has come in the form of more people buying GameStop stock in the short term that has run up the stock price in the short term, which is, well, it's not good news for the short sellers. Now, a short seller is someone that is betting the stock will go lower in the near future. When it works, man, it works well. When it doesn't, it can be a disaster for the short seller. A short seller essentially borrows the shares, let's say, for example, 100 shares of a company like GameStop from a broker, and for a fee, basically on margin, and the broker loans the shares out to the short seller at the current market price. The short seller immediately turns around and sells those borrowed shares in the stock market, hoping the share price will go down within a given period of time before his or her mark is called in by the broker to return the shares or pay for them at the now current price. If the price per share when the short seller buys them back from the market is lower, he or she makes a handsome profit. But if the price is higher, the short seller has to pay the higher stock price to return the shares back to the broker. A total disaster. Here's a question for you. Did you buy GameStop? If so, leave us a comment below if you bought in. Let's consider Melvin Capital and Citron Capital, both hedge funds that close out their short positions on GameStop in reaction to the recent meteoric ascent of the stock. Citron Capital said their firm was able to cover the majority of its GameStop short bets at a 100% loss. Now, when you say majority, does that mean that some of the bets weren't covered? Well, I can't imagine how many billions that might be in terms of dollars. Short selling isn't anything new. Institutional investors as well as savvy hedge fund managers have been doing it for ages to add additional profit to their hedge fund and ultimately to enrich themselves. Short selling adds no value to the overall market. Most of the time it's used to, push the price of a stock down, usually followed by short sellers' documented comments on TV or online as to why they're shorting the stock, sometimes on unfounded bad news in order to encourage a continued drop in the stock price. Yet, no one seems to care that these characters do this. What has changed this time is that the retail investor on the other side of the trade decided to punish the short sellers by buying up the stock and thus causing the stock price to run up, and then force many short sellers to close their positions in order to manage the damage that has already been done. I tell you what, short selling is not for the timid. In 2020, Tesla short sellers, they were nicknamed Tesla Q, the Q being for the character stock exchanges add to a stock ticker symbol after the company files for bankruptcy. Joke. Those Tesla short sellers, they lost some $38 billion. That's a hard loss to make make up for in any hedge fund manager stock portfolio. And recent data indicates that GameStop is among the S&P Composite 1500 most heavily shorted stocks as a percentage of shares available for sale, meaning more shares are being shorted than actual shares available. This would indicate naked shorts have been sold. Naked shorting is considered illegal. That is illegal practice of short selling shares that, they don't actually exist. This behavior also indicates that multiples of hedge funds were crowding the same trade for the short sale opportunity. I said crowding, not collusion. It appears these large position short sellers got very comfortable with this behavior. But you have to realize everyone looking can spot an elephant feeding frenzy, and that appears exactly what happened. The tables were turned and short sellers, they were burned. Some savvy individual investors simply followed these market elephants as they crowded together and moved from one short selling opportunity to the next, enriching themselves. Individually, these retail investors decided to buy into one of those positions and move the price of the stock up. That stock was GameStop. Going short on an individual stock, it can get you margin called into bankruptcy. And that's exactly what you're starting to see with some of these hedge funds that are, they're trying to cut bait, pay up and hope they have enough cash to remain solvent. Some short sellers, however, have decided to double down on their bet. And if they're wrong, the outcome for the fund and its members, it'll be catastrophic. Just how big and how bad is the GameStop or Game Stunk, as Elon Musk called it? Well, Ihor Doswinski, managing director at SG Partners, says it's not just the largest market-to-market loss for any stock this year, it is the largest yearly mark-to-market loss he's ever seen. Now, Wall Street is calling foul. Some are even asking the SEC to look into this. But there doesn't appear to be anything to look into, just hundreds, if not thousands, of individual exuberant retail investors acting on their own behalf to make the market work for them rather than the other way around for once. Now, will this curb the appetite for gang short selling on Wall Street? I don't know, but it will certainly cause these elephants to think twice before acting the next time. There's no doubt it will have some negative impact on the market overall, especially if insolvency amongst hedge firms increases as a result, which would cause many of these firms to find ways to shore up accounts, which may mean they need to, offload some stocks in the short term, which could also mean possible future stock price depression on some stocks held by these hedge fund managers. Is this the beginning of a new occurrence in the market or a one-time event? What do you think? Leave your comment below. So what happens to GameStop now? I'm not sure, but I think I'll pull up a chair, bucket of popcorn and a drink, and watch it unfold. We'll see you next time.